Thank you for joining us. Welcome once again to Mid-State Money Talk. Joining us on the desk today is Al Dietrich and Kevin Dietrich of First Choice Financial Services. I'm your host, Mike Spangle. And Al, I got to start with you, the big man on the desk here. Oh, yeah? What's on your mind? What do you want to talk about this week?
I think we'd like to talk about tools that we use and some of the uses for them, familiarize the clients that are prospective clients that are sitting out there, our viewers, and let them get a glimpse of what we do.
You're right. Kevin, you and I have talked about this a couple of different programs as well, that today's retirement's a little bit different. Even the tools have become a little bit better, but we need to review them from time to time, making sure we're using the right kinds of things. Right. Everything from the 401k, maybe even to insurance-based tools that we use from time to time. Are you starting to do a little bit of that reviewing yourself in the office?
Oh, of course. We go through all of our clients with that review and make sure that the tools they have, their investments are where they need to be properly. And it's not just for the benefit of the person who set those up, their former financial advisor. It's for like what's going to be useful for them going in the future. Right. And that's where like refinancing your retirement is a key, like terminology or phrase right now. Well,
thank you so very much. We're going to have to explain that a little bit for our viewers. Maybe you've heard it on other radio programs or television shows. Refinancing your retirement. What does that mean? Well, for us, it means possibly putting more dollars in your pocket to spend in retirement each month. Yep. Now, Al, I understand this. If you refinance a mortgage, number one, this is a concept across the country that people are very comfortable with. If you had a higher interest rate and interest rates come down, you go in to refinance your mortgage. You get a hopefully lower interest rate. Sure. What does refinancing your retirement tools mean?
Well, people do it a lot on their own, and we have more tools to work with. So a lot of folks come into the office and they say, "Hey, I saw this CD at the credit union down here. It's 4%, and the one I have now is 1.5%. I'm going to go refinance it. I'm going to go take that out and put it into the larger CD." And of course, that's a tool. And we use that tool for some of our clients, or well, many of our clients, for their short-term money. And so, so that's what we do, except that we have the opportunity to use so many more different tools for different uses of that midterm money and the long-term money as well.
Okay. People do this all the time with CD money. The money they want to keep safe, earn that guaranteed interest rate. They do it all the time. They have a CD, like as my dad mentioned, that's earning 2%. With it now down to the local bank, it's 4%. So they're going to move that money when it matures over to the new bank. And so they're refinancing that portion of money to get a better rate of return. We can do the same thing, and we utilize annuities for that.
Okay, all right. And so they're insurance-based tools, right, from billion-dollar, trillion-dollar insurance companies. And there are better offerings today. So let's go backwards a little bit. The interest rate environment, that changed on us about 2.5 years ago. Yep. In fact, some of the independent studies from LIMRA, this is an independent reporting company, been around for about 90-some years. They've reported for the last 2.5 years record-breaking infusions into these annuity tools. Over $300 billion, I think, in 2021, $360 in 2022, and they're on a record-breaking pace this year. Al, do you think this is in part because there are better interest rates now?
There are better interest rates today. Interest rates change. They come up, they go down. They come up, they go down. So I believe that people need to look at the short-term goal, the midterm goal, and the long-term goal. And so if you can lock in a 5.5% account today for 5 years or 7 years or 10 years, that might be something that, you would consider with part of your funds. And so that's what we talk about. We do what's called a laddering strategy, which helps them to determine what they need here in the next 24 months and what they need in the next 5 years and so on and so forth. So the tools themselves have been improved. And then, of course, the rates of return, you're dealing with multi-trillion-dollar companies here, billion and trillion-dollar companies. So, they can offer stronger rates for longer periods of time. So we want to make those available to clients that fit their needs, fit their portfolios.
Okay. I'm glad you mentioned ladder strategy, because we see that all the time. Folks come in and they ladder these CDs that we're referring to right now. So you might have a 18-month CD and a 24-month CD, a 3-year CD, and they're laddering them as they come due, as they mature. They're moving them into another either long-term or mid-term or short-term goal. We use the same philosophy, but we have better products to choose from to give you higher rate of return, but still keep your money safe.
Right. Now, Al, this is something you did want to say, though. There are other, again, all kinds of programs and even online information that will either say an annuity is good or an annuity is bad, don't ever do this, or put all your money here. You're kind of in the middle on all of that. You're like, maybe it's a tool you could use, maybe it's for a portion of your assets. Could you explain maybe where it does or maybe doesn't fit for somebody?
Sure. Again, we work with everything, whether it's stocks, bonds, mutual funds, investment and property, whatever it is, we'll work with that for you, But a lot of times when we're accumulating our wealth, the tools that we use are pretty much cut and dried. But then you have tools that have been designed for the distribution stage of your retirement. And annuities happen to be one of those tools. Now, they say if you have a hammer, you go around looking for a nail, right? But annuities are simply a tool that we use. And the reason we're talking about it today is to inform, our viewing audience and try to bring them up to speed a little bit on how they've changed how the uses of those accounts today fit into their portfolio and into their planning.
Wonderful. I'd like to talk about that a little bit, if you don't mind, after the break, exactly how these things have changed. Again, this is not your grandfather's Oldsmobile of retirement, right?
That's
right. The tools
exactly.
are updated themselves, and you can get started on a review yourself. Refinancing your retirement. How can you actually increase your spend in retirement, possibly by reviewing the tools that you might already be using and seeing if there are better rates available today? We can do that second opinion review for you. You can call the phone number down on the bottom of the screen, set up your appointment, and we'd be glad to sit down with you. We don't have a minimum. It's not about a pitch or a process. This for us is just a conversation to see what would you like your retirement to look like. Let's get that conversation started. Call the phone number you see down here. More Mid-State Money Talk when we get back right after this message.
When we tell someone something, they'll say, we can take that to the bank. If we can't do something, we'll tell them that. We're straight up with our clients. It all comes down to using the products for the people's needs, not selling product.
Being independent means that we have freedom to do what's best for our clients. We're not beholden to any other party to make sure that we're meeting a quota or restricted on what it is that we can do or provide. We're free to go out into the market and find what's best for them and what's going to meet their needs.
The world's our oyster, as far as what resources we have for our clients, and that's beneficial for our clients more than anything.
Don't be afraid to go ask for help. Find somebody you can trust and start the process. Obviously, the financial part is very important. Having a plan in place that's going to provide you with sustainable income, that's resilient to the changes of life and of the market, that's really important.
Money doesn't care who it serves. And one of the things that we like to do in our company is we like to be able to help people determine where their money is going to be and who it's going to serve generation after generation.
Welcome back to Mid-State Money Talk. On the desk today is Alan Dietrich and Kevin Dietrich, both father and son, and more importantly, retirement income specialists here with First Choice Financial Services. Now, as we're talking about refinancing your retirement, it's a concept, it's a bunch of words. It doesn't mean a lot unless we maybe have some sort of background on it. Who have you helped recently with something like this?
Oh, sure. We help a lot of folks like that. A particular couple comes to mind. They were married, and they both are very conservative in their risk tolerance, and so they're heavily invested in CDs. And they use that ladder strategy a lot in their investment portfolio. So they might have 10 CDs apiece, laddering from a 12-month all the way up to a 3 or 4 year CD. So in their risk tolerance, they're very conservative. They don't want to lose any of the money. They like that guaranteed, and a principal protection. So in the indexed annuity world, we can have the same type of principal protection, but a higher rate of return, possibly. So we're able to move those in slowly as they mature. into that ladder strategy on our end. And so they were very happy about that. They're seeing the level of returns coming up a little bit because we are in a different market and a nice investment market.
Currently, yes, with those interest rates. And what's been nice about that, like you said, better offerings. We don't know if everybody is a fit for every single one of these kinds of tools.
Right.
But you're right, though. We have seen pretty good CD rates over the last couple of years. Mm-hmm. But the flip side of that, Kevin, is that we've also seen interest rates now starting to come down. So is the window closing on both the annuity offerings and CDs? Where, none of us have a crystal ball, but where is it going in the next maybe couple of years?
Yeah, I mean, I think that the indexed annuities are not necessarily the same as the fixed annuity or like a CD. So similar, a CD is a fixed rate return, give you principal protection. A fixed annuity is the same thing. It's a fixed rate return with principal protection. An indexed annuity is invested in indexes in the market, and so you're able to gain those market type returns, but with the same level of principal protection.
Yeah. Do you think you look at those kinds of tools, annuity tools, insurance tools, as emotionally as the American public does? Or do you look at it like going through a toolbox, like, well, this one is not for you, and this one, like you said, a lot of people, if you got a hammer, you're looking for a nail.
Yeah, it's based on our planning. Our review that we have done with the client, and it's all based on the planning. What's their risk tolerance? Are they conservative, moderately? Are they aggressive? What do they prefer in their investment vehicles? And so what's the best fit for them? Not for us, but for them.
Right. And so as independent groups, so as First Choice Financial is independent, maybe we could explain a little bit around that. Independence means you're able to use kind of the whole world of product offerings that are out there. Or are you even a fan of the word product? What do you prefer?
Yeah, we do like the term tools because if you're talking about product, you're talking about insurance industry. If you're talking about funds, you're talking about the assets under management and so on and so forth. So we want to be able to use the right tool for the right purpose. So after we go through our 5-step planning program, we like to break it down and in the term of needs, inflation, and wants. And when you look at the needs today, a lot of people talk about Social Security being the base for retirement planning. With it at risk, do you really want to call it the base of retirement planning? So we need to have something there that will be guaranteed for the rest of your life, regardless of legislative risk or whatever it is you want to talk about. So we don't look at the planning tool for like Social Security being that which starting age is going to give you the highest return. Mm-hmm. The highest return may apply to a few people, but which of these, where's your sweet spot so that we can turn that on at the point of need and have it serve a part of your needs base. And then, of course, we go into finding something else that is safe and guaranteed. And so we go to whatever tools are safe and guaranteed, and we try to then come in and supplement that in a way that the clients are happy with. Because there's a lot of different ways that you can get from here to there, and there's different tools to use.
You know, what's interesting is that you guys definitely share, because I had an independent conversation with Kevin one time, and you said the same thing, sweet spot.
Yeah.
It's not just about waiting, because honestly, most Americans don't wait until that age of 70. I think it's near 90% of folks take it either by full retirement age, maybe a year afterwards. Hardly anybody's waiting.
A lot of folks are even taking it earlier.
Yes, much earlier.
We did an episode a while back, it's not your father's retirement.
Yeah.
And it's not your father's retirement. So we're seeing a pivot or a shift in the baby boomers, if you want to call it, or the generation after that, as they're approaching retirement, that they want some more guarantee in their investments. They've seen the market do all of this with their parents being frustrated because the market's doing all of this, right? And so there's a shift. And so we use these products, or if you want to call them, or tools, we like to call them, as a tool for that particular safety net.
Yeah, you even talked about a phrase and saying doing something like creating your own privatized pension. So that's using what? Our our savings, those 401ks, those other tools.
Sure.
Is this cashing in life insurance? How do we create our own version of a private pension, Kev?
Yeah, we utilize your current investment resources that you have, either IRAs, 401ks, if you have CDs, which are non-IRA money a lot of times. And so we utilize whatever is best fitting that particular need for your plan to fund those guaranteed sources of income or
Right.
private pensions.
We've had a phrase that we've been kicking around, better is better. Better, we're all striving for a better retirement, sometimes in refinancing your retirement, maybe a better car.
My dad says gooder is gooder.
It's throwing Dad under the bus after he built this industry for you here,
right.
Kevin. Come
It's
on.
same difference. Better is better, gooder is gooder.
My grandkids love gooder is gooder.
But the 5 points of what you do, when we're talking about better is better, trying to create a better retirement plan, people might not know what to do as far as better. What are the 5 things? So like Kevin takes a lot of first appointments. What are the 5 things that you've got to talk about in that first discussion?
Yeah. Go ahead, Kevin.
So we do a financial review, which is really an investment planning, income planning, all that stuff. And then we do an income plan, tax planning, healthcare planning, and then of course legacy. What do you want to leave to your beneficiaries and how long you want your money to last? Those are our 5 steps. And so we go through each of those categories, and there's obviously tons of questions involved in each of those as well, trying to just really pick apart what your plan wants to look like.
Yeah.
And we'll put together a plan for you based on those needs and wants, inflation, taxes, all that stuff.
And we've talked about this before, sometimes making the doctor analogy between the financial advisory group and that you need some intake first, right? And that's kind of your first point when you go to a doctor and you get labs done and the doctor's like, what is it that you're trying to do? What hurts? How do we fix it? And you can't all do it in that first appointment, right? And so you collect this information, Kev, then what do you do with it? What's the next step in the process?
We get to work, and we plug it through our software systems, and we actually get down on pen and paper, calculator, and we do the planning right then and there, individually, customized for that particular client.
Can I tell you that when we do that, now we have to find solutions.
Yep.
Okay, the problems are evident, the solutions not so much. So when we find the solutions, we find what we want to use, and then we take another step and we find the top 5 or 10 tools in the country available for that. And that's when we start going to work and deciding, okay, let's show them A, B, and C, see what they're most comfortable with, because all 3 will do the job.
Yeah.
And better is better.
And not gooder?
No.
Okay.
And best is best.
All right. Yeah. One thing I want to ask you, though, when we come back, though, one of those tools that we're kind of given is just our 401k when we go to work. And has that been a good enough tool to get people to retirement? Maybe we can talk a little bit about that when we get back.
Happy to. Yep.
You can get your own 5-point review from the team here at First Choice Financial Services very simply by calling the phone number on the screen. There are folks standing by right now. They'll schedule the appointment. You'll come into the office. You'll very likely sit down with Kevin, and we'll go through these 5 steps in the process. Figure out where you're at. Then, as Al said, they go to work. We look for the solutions, the best ideas for you, and we'll present them for you and show you what better is better could look like for your retirement plan. Call the phone number right now on the bottom of the screen. More Mid-State Money Talk right after this.
I was in Colorado, actually, pastoring a church. I just felt a disconnect or a lack of peace at the church there, and so I was praying and asking the Lord for direction. So I just felt like He had given me a burden for my dad. He was working 60, 70, 80 hours a week at his age, and I just felt burdened for that, and I wanted to, help him out. So I, approached him about it one week where they were visiting over Thanksgiving, and he says, God didn't tell him that. We laughed, but we prayed about it further, both of us, and we just felt like the Lord was leading that way. So we made the arrangements and moved my family back home to Pennsylvania. And so I was helping my dad out part-time, sort of. But the more I learned the business, the more I understood what he does and what benefit I can have for clients and people's lives. And it was just a calling, like my dad says, it's a calling for him, and I think it's a calling for me. The Lord prepared me for this place, in this time. So I got my license and started selling, and I was successful. I was doing well, and once I got my license, the business kept doubling. So we kept increasing our revenue, our profits, and then helping more clients in the long run.
Welcome back. You're watching Midstate Money Talk, and we're talking about different solutions that we can hopefully provide for you out there, but it usually does start with a meeting. I mean, not a lot that we can do over the air. We've got to take a look at your statements, find out exactly how old you are.
Right.
But Kevin, something interesting you said was that even small adjustments, little tiny things, can really make a big difference.
Yeah, I want to come back to the whole idea of better is better, because just these small adjustments, you might be working with an advisor currently, and that's fine if you're happy with them. And sometimes just doing that second opinion, that review, and seeing where we can make these small adjustments to make your plan better, because better is better. I was working with a couple one time, and she had a a fixed annuity that she bought 30 years ago, right? So it's their grandfather's annuities, right? And so at that time, it was making like 4 or 5% interest, fixed rate for, let's say, 8 years. Well, after the 8th year, it automatically renewed like a CD does, right?
Okay.
So it renewed at a 1% interest rate. And then it kept renewing at a 1% interest rate until 30 years later. And she was like, I hate annuities. I said, why do you hate annuities? And she showed it to me. I said, I'd hate that annuity as well, because she just wasn't informed. And because things can get better, right? There are different tools out there. As every year, they're creating better tools. I just think in the last year, we see some great tools created in the annuity space that can just better your retirement going forward.
Right. Oh my God. And you don't know what you don't know. That's a phrase as well.
And it's really important to get that second opinion. Dad's got a story that is really good about that second opinion.
Yeah.
I had a client that's been with us for a long time, and they retired. I think it was in 06 or 07. They came in, and we were taking a look at some things, and they had another firm set up their retirement, and most of it was in assets under management, which is fine, right? But they ran into some hardships in 08, and they came in and said, Mr. Dietrich, we came to your workshop. We wanted to come and talk to you. You seem to have some different ideas about things. We'd like to find out what your opinion is here. Well, back in 08, what happened is they had to put a new roof on their house. They had to get a new car, and they already had a 30-day trip scheduled for Europe, all in 1 year. And the market was down, okay? And so they said, we lost a tremendous amount of money. And I said, well, what was the cost to do all of that? And they said, well, it was $68,000. I said, okay, that's a nice little chunk, And they said, yeah. And I said, so how much money, what was the value of the assets you sold to get to $68,000? They said $124,000. So they used $124,000 of value in their portfolio because the cost of the assets went down to pay that $68,000 debt. That to them was extremely difficult. So they said, what would you do to fix this? So what we did is we did our 5-step plan. We allocated money for emergency funds like that. We allocated funds to give them a lifetime income to supplement their Social Security. And then, of course, we used the appropriate tools to forecast the balance of years along with inflation to have every few years have a step up in income for them. And these folks are with us today, and they're happy as can be. Mm-hmm. But it was all about planning for those unforeseen things that, how can you plan for those in a non-guaranteed environment?
Right. We're planning for the unknown, but some of the numbers that you've talked about before is that if a couple reaches the age of 65 together, 70% chance that one of you will need long-term care. I mean, it's no longer an unknown. It's a pretty sure. And there's a 25% chance that both of you might need, because if you got to 65 together healthy, that means we might live longer and longer. And another discussion we've had is that we spend a lot more money in those last couple of years.
Oh, yes.
So can we protect those things? Can we insure those things and maybe have those retirement dollars stretch out a little bit further?
Well, obviously, yeah, we can do that. There's tools out there, annuities, one of them, life insurance, one of them, that we can supplement some long-term care benefit. You don't have to go out and buy long-term care insurance. That's very expensive, and it doesn't really keep up with inflation. So, but there are other tools out there that we have at our disposal because we are independent, that people aren't really aware of that. It's like my dad calls it the elephant in the room, long-term care. And because no one really wants to talk about it, but it's there, present, big, right there, you know. And so when we bring that up in our workshops, when we bring it up into our meetings, they say, yeah, it's a concern, but I don't know what to do about it. Well, I'll show you what to do about it. And so we do some planning. Everything that we do is planning, planning. We do some planning, and we show them a solution to it, and they love it. They absolutely love it. They say, that's what I'm looking for. I can sleep better at night because I have this solution now.
Yeah, and some of these tools, these solutions are things that either our public hasn't heard about, or maybe they've heard about in a bad way.
Yes.
And we just have to present and say, hey, no, this is the realistic on it.
Can I add to this? Is a lot of times we'll have multiple solutions for them, and we allow them to pick the one that best fits their comfort zone.
Correct.
You know,
Yep.
and so yeah, that elephant in the room is something that should be discussed. It's usually glossed over because you don't have to go. Not that a nursing home insurance policy or long-term care insurance policy is the worst thing in the world, but it's not the only game in town.
Right.
You know?
You could have in-home care, but I understand
Yes.
that can also be very expensive.
Precisely.
Which do you guys find, which is more expensive, going into the facility full term or trying to have somebody come to your house 5, 6, 7 days a week?
Nursing home, by far.
Okay.
The national average, I think, is like $115,000 a year. That's the national average. Pennsylvania, it's like $144,000 a year. And so, and in-home care is like 60, about half of that. You know, so that's a huge difference, right?
Yeah.
And of course, you want to have care in your home. Who wouldn't, right? So we
Right.
plan for all of those, and we give those. That's the type of options my dad's referring to. We give those options. What do you prefer?
Yeah.
And I've seen some great long-term care policies that have been taken out 20, 30, 40 years ago that have a great benefit, that have kept up with inflation, but they're a dime a dozen.
Thank you both, Al and Kevin. Especially what Kevin was saying there is that sometimes just doing a review, you don't realize you might be holding a tool that is no longer working for you. There might be lower costs. There could be something that can actually last much longer for you in your retirement. You don't know what you don't know, but we want to make your retirement as better as we possibly can. It all starts with a phone call. There's no cost to sit down with the team here. Dial that phone number down on the bottom of the screen, schedule your appointment. We'll go over our 5-point review for you at no cost. Thank you for watching Midstate Money Talk. We'll be back next week.